February 26th, 2026. Geneva. The talks are indirect, the room is tense, and the mediator is Oman. On paper, this is the kind of meeting that's supposed to reduce risk. In the market, it does immediately. Oil prices slide because traders smell a chance that supply fears are easing. But here's the paradox. The same week diplomacy shows up, pressure also shows up. New sanctions hit networks linked to Iran's oil trade. And the backdrop isn't calm diplomacy. It's military assets moving and warnings being traded. So the headlines look like a contradiction. Talks resume, talks end, no deal, progress. Then technical talks get scheduled again. It keeps cycling. And that's the hook. Because what if these negotiations don't keep coming back because leaders suddenly rediscover peace? What if they keep coming back because sanctions are a throttle on money, oil is a pressure gauge on fear, and talks are the system's least costly way to adjust both without admitting it? So what's really going on? What you're supposed to believe is simple. The U.S. and Iran keep returning to nuclear talks because everyone wants to avoid a bomb, avoid a war, and restart diplomacy. But what's actually driving the loop is less about speeches and more about switches. Sanctions are a global money switch that can tighten or loosen Iran's ability to get paid, ensure shipments, clear bank transfers, and attract investment. Oil is the fastest feedback loop on Earth, and markets react in real time to any hint that supply risk is easing. In this video, we'll solve the puzzle in 3 lenses. First, how U.S. sanctions really work in practice and why sanctions relief is not a single button. Second, why oil prices move on diplomacy headlines and what that tells you about leverage. Third, why the talks keep coming back from the dead, even when no deal happens, because both sides can't afford the worst outcome. But neither can sell a full compromise at home. Then we'll end with what this means next, the most likely path forward, and the triggers that could break the cycle. To understand why these talks keep resurrecting, you need a clean baseline. This is an indirect negotiation, mediated by Oman, happening under the shadow of military escalation and the risk of a wider regional war. Here's the minimum timeline you need in your head. 1. The U.S. and Iran meet in Geneva for another round of indirect talks, and they leave without a deal. 2. Mediators describe progress, and both sides signal that talks will resume soon, including technical-level discussions in Vienna. 3. At the same time, the U.S. keeps tightening pressure with fresh sanctions tied to Iran's oil trade and related networks, while military assets in the region raise the stakes. 4. The market reacts instantly. Oil prices slide when traders see diplomacy reducing the odds of supply disruption, and they spike when fears rise. Now, define the key terms in plain English. Sanctions here means more than banning U.S. companies from doing business with Iran. It means making banks, shippers, insurers, and trading firms worldwide treat Iran-linked deals as legally and financially toxic. Sanctions relief isn't one dramatic announcement. It's a sequence of permissions, waivers, and risk signals that determine whether money can move and whether oil can be sold with normal costs. Finally, map the stakeholders. Iran wants breathing room, oil revenues, payments, and investment access. The U.S. wants verifiable constraints on Iran's nuclear path, but it also wants leverage it can turn up or down without firing a shot. And the rest of the world watches oil as the scoreboard, because the price moves when the risk moves. If you strip away the speeches, this cycle is powered by one thing: leverage you can dial up and down without firing a shot. In this story, that leverage is sanctions, and the scoreboard is oil. Think of sanctions as a global risk tax that gets added to every step Iran needs to turn barrels into cash. Not just selling oil, getting paid, clearing payments, ensuring shipments, finding banks willing to touch the transaction. That's why the most important phrase in these talks is not a deal. It's sanctions relief. Because relief isn't one button. It's a chain of permissions, waivers, and enforcement signals that determine whether Iran can function like a normal exporter or like a smuggler with a huge premium attached. Now here's the mechanism that makes the talks resurrect. Lever 1. Pressure increases when Washington tightens the net. New sanctions don't just punish Iran. They raise the cost of compliance for everyone else, so banks, shippers, insurers step back. Lever 2. Risk increases when military posture hardens, because markets start pricing disruption before it happens. That's why oil can spike on fear and slide on the smallest hint of de-escalation. Lever 3. Talks appear as the cheapest release valve. Not because trust suddenly exists, but because both sides need a way to lower the probability of the worst-case scenario without looking like they blinked. So the cycle looks like this. Pressure rises. Risk rises. A mediator opens a channel. Markets react instantly. Then the talks hit the same wall. Relief versus verification. Timing versus trust. Now versus after you prove it. And that's how you get talks that never die. They don't have to succeed to be useful. They only have to keep the system from tipping into a point of no return. Proof 1. Oil prices move as soon as the headline moves. Before any centrifuge changes speed, before any document is signed, crude reacts to the probability of supply disruption. When traders believe talks reduce supply fears, prices slide. When tensions rise ahead of talks, prices jump. That's not because oil traders care about diplomatic language. It's because the Middle East risk premium is a real-time number, and it changes with perceived escalation. Proof 2. Pressure does not pause for diplomacy. On the eve of talks, the U.S. issues new sanctions tied to Iran's oil trade. This is the double-track strategy. Negotiate with one hand, tighten with the other. Why would you do that? Because it raises the value of what you can later remove. It turns relief into a scarce resource. And scarcity is bargaining power. Proof 3. The talks end without a deal, but the process survives because both sides still need the valve. The latest round wraps up in Geneva with no announcement of a deal, yet both sides signal the talks will resume, including technical-level discussions in Vienna. This is the giveaway. If the purpose were only a clean, final agreement, no deal would be the end. But it isn't, because the ongoing process itself reduces immediate risk, stabilizes expectations, and keeps leverage tradable. In other words, the talks don't have to produce a treaty to produce economic effects. They just have to keep the market and the region from panicking into the downside path. A fair objection is obvious. You could say, stop overthinking it. These talks keep returning because the nuclear issue keeps returning. Because enrichment and verification are the core. Because a bomb would change the region permanently. That's true as a threat, but it misses the mechanism of control. The nuclear program creates urgency. Sanctions create leverage. And leverage is what makes talks possible on a repeating basis. If you remove sanctions from the picture, what tool is left that can be adjusted gradually? Military force is not gradual. It's binary. And once it starts, it invites retaliation, regional escalation, and a shock to energy markets. So yes, nuclear risk is the reason the problem exists. But sanctions are the reason the negotiation keeps resurrecting. They're the dial that can be turned in increments, in public and in private, without immediately crossing into war. And that's why the talks don't end when they fail. Because failure doesn't remove the need for the dial. To judge whether this cycle is breaking, you need criteria that don't care about rhetoric. 3 tests. If it fails 2 of these, you're not watching a peace process. You're watching a pressure management loop. Criteria 1. Visibility of relief. Not promises, not vague pathways, but something Iran can measure in cash flow. Can oil move with lower risk premiums? Can payments clear through less fragile channels? Can shipping and insurance costs normalize even slightly? Criteria 2. Sequencing that both sides can sell. The U.S. wants verification before relief. Iran wants relief before irreversible concessions. So the only workable sequence is small relief for small, verifiable steps, repeated in layers. If either side demands an all-or-nothing jump, the loop resumes automatically. Criteria 3. Durability under domestic politics. A deal that can be reversed by the next political shock is not a deal. It's a temporary waiver schedule. If Congress, hardliners, or security escalations can snap the agreement in weeks, then the talks are just a rotating door for leverage. So what's the verdict right now? We see signals of progress, and we see technical talks lined up. We also see sanctions pressure still tightening at the same time. That combination usually means this. The system is stabilizing the immediate risk, but it's not yet proving the one thing that ends cycles: credible, staged relief that survives the politics. Here are the three most realistic paths forward. Not predictions, conditional scenarios, each with triggers you can actually watch. Base case, managed limbo. Talks continue. No grand deal. Instead, narrow technical steps, quiet messaging, and sanctions that remain mostly in place, maybe with small tactical flexibility. Trigger. Both sides keep insisting on red lines publicly, while letting mediators keep the channel alive privately. In this base case, oil stays choppy. It falls on talks are progressing headlines. It jumps on military posture hardens headlines. The market becomes a mood ring for escalation risk. Upside case, stage relief for stage constraints. This is the only exit that actually fits the economic mechanism. The U.S. signals a limited, reversible relief package. Iran signals limited, verifiable nuclear steps that don't look like surrender at home. Trigger. The mediator produces a sequencing formula that creates immediate economic oxygen without requiring either side to bet everything on trust. If this happens, the first effect won't be a Nobel Prize headline. It will be boring, technical shifts in risk pricing, shipping, insurance, payment channels, and oil's risk premium. Downside case. Channel breaks, pressure turns kinetic. The talks collapse, not necessarily because someone storms out, but because one side concludes the other is using diplomacy to buy time. Then the dial gets replaced by the hammer. Trigger. A major escalation event, or a political move that makes any relief impossible to sell domestically, combined with rising military postures. If the downside triggers, oil doesn't just react. It reprices the region, and the costs don't stay local. So here's the real takeaway. U.S. Iran nuclear talks keep coming back from the dead because they're not only diplomacy. They're the global system's least costly way to adjust two things that matter immediately: money flow and oil risk. The nuclear issue creates the cliff. Sanctions create the steering wheel. And talks are what you call it when you turn the wheel without admitting you're doing it. Now your call. Do you think the next month looks more like managed limbo, a stage deal, or a slide into the downside path? Comment with base, upside, or downside, and the one trigger you're watching that would prove you right.